Hello! I know it's been a while since I last appeared on YouTube, so thought I would just give a quick update on the market. It's been really busy lately. So I think this topic will be very interesting because it has a very important effect on Singapore property prices. And of course, we are talking about the interest rate drop and the effects on Singapore properties. So I think by now, it's everyone should know about this, right? It's not a matter of if, actually it's just a matter of how much the drop will be. And if you're going to take the cue from the Fed and from US, inflation has already tamed down. So the bigger questions about how aggressive the rate cuts will be actually dependent on their jobs, their unemployment data that comes out eventually over the next few months, right? So it's not just from US. I think you understand that the entire global economy is kind of slowing down, and governments are actually doing as much in this sense to really try to prop up the growth and to make it still growing consistently. So you see from Europe, this one, ECB has already started to cut rates. So it will be coming down. You can see over in the chart predicting an ECB rate cut ever since their hawkish sentiment since 2021 to 2023, peaking at 2023. The dovish sentiment has always been increasing, and now we are at the point whereby they are all expecting rate cuts to be more aggressive. And it actually sings the same tune with the economy. You can see at the top right, these are all from Bloomberg. The UK economy is not doing well. It's stagnated for a second month, and I think this is also below the general economy's consensus. So I believe they'll be doing more eventually moving forward. I mean, by and large, I think the Europe economy isn't doing as well as the US. So definitely they will be the first to be cutting rates. So we have US, we have Europe. Lastly, of course, we have Asia, China. I think China is something very unique. I think they have been in the doldrums for quite some time, I think, because of how the property market has really affected them and how, they have been really too centered around this entire sector, and then now they are trying to diversify out of it. But at the same time, the government, do not want to adopt the Western style of doing quantitative easing, unleashing all the market with a lot of money. It's not their style. Right, but at the same time, we have to appreciate that it will take some time. So it's tracking along, and I think it's not really working well for them, and they want to be a bit more aggressive. And so you can see from this article that they're intending to actually cut rates on all their mortgages, totaling 5 trillion. I think that's something huge. Right, and this will really free up a lot of disposable income for consumers. And with this, it's something like our CDC vouchers that we can use in our supermarkets and hawker centers. Imagine these are more cash because their rates will be lower, and it will really spur household consumption. So the global economy, has started to kind of consolidate, slowing down, and that's the reason for more aggressive rate cuts. And also the inflation sentiment has come down. So the question now is, how is Singapore economy doing? Because we understand that when interest rates drop, the whole idea is because that the economy isn't doing great. So how is Singapore economy doing? I think if you've been following the news, we are quite lucky in the sense that we are still based around this Asia and Southeast Asia region, which I feel has been quite insulated from the slowdown from the global economy. You can see as the interest rates start to come down, expectations of it coming down, markets around here have started to rally in that sense because we are surrounded by Southeast Asia economies. These economies are generally constitutes these emerging markets, right? Emerging markets do very well when interest rates starts to come down. Thailand is doing well. You can look at the stock market. Indonesia, even Malaysia, I read certain reports that says that it fared like the best last 3 months in the last 5 to 10 years, something like that. Even Singapore market has also done reasonably well. So why is that so? I think because the growth around this region, previously I talked about the macro trends about how Asia and Southeast Asia in particular would be really the silver lining out of everything in, I would say, in this decade. So as of now, I think this theme is playing out right. And with these interest rates coming down, and because of all our economies here, all our markets here, we are actually price takers in terms of the Fed rates. So when interest rate comes down, it will definitely benefit consumers by spurring demand and more investment, more bullish kind of sentiments coming into play, right? So this is reflected, you can see here from Yahoo code, from the Southeast Asia ETF. you can see they break through this trading range that has been there for the last 5 years since 2020. So it's actually doing quite well in Southeast Asia. Singapore per se, these are two latest newspaper articles, one from The Economist, has really raised Singapore's 2024 growth forecast to 2.6%. And then internally, MAS chief also see GDP growth being on the upper end of the 2 to 3% range. I think this is something very positive. You can grow at 2.5 to 3% for quite a mature economy like Singapore amidst all the uncertainty around. I think that's something very, very positive. And with that, the backdrop of rates coming down and boosting more demand, I think this in general should really bodes well for Singapore. Although I know there are certain sectors that are not doing well, but maybe these are just a bit of a sector rotation. By and large, I think Singapore in general is still doing all right. Okay, and when the rates came down, if you have been following my YouTube videos, in one of my commercial YouTube videos, I talk about how REITs can be a good diversification play because they were at the rock bottom when inflation peaked and when the interest rates was at the highest. Now, there's some sentiments coming back. You know, some people are already more forward-looking with rates coming down, and we have experienced quite a bullish, rebound in prices, right, from the 0.775 to 0.844 for this one of the most popular ETF that reflects the REITs in Singapore and in Asia. Okay, I'll say, but the main constituents of these REITs is still very Singapore-based. So this has already reflected the sentiments of rates coming down. And equities, all these things, they are the fastest to react to it. Okay, so because of all these things and rates coming down, property prices, I would feel, would be supported. In the last couple of years, we reached a certain benchmark of the 2,000 per square foot, and we have been kind of a bit of a sideways consolidating. We haven't really go aggressively much higher. I feel that the consolidation is more of the price moving outwards rather than upwards. But with the interest rate coming down, I feel that this new benchmark pricing, a lot of people still don't believe that this 2,000 PSF, let's say for the new launch market in the outskirts, it's a real pricing that can be supported. But it has already been solidified for the last 2 to 3 years. And with the rates coming down, I think it will form really as a base, and then maybe, usher in the next upsurge in property prices. We may not know. Right, so there are 4 main catalysts how I look at it with interest rate dropping. And of course, why I'm doing this before the rates start to really drop aggressively is we always want to front run. I always want to be forward looking, always want to be proactive rather than reactive. So, because if we really act when the rates are, let's say, below 2 or around 2%, maybe everything, all the prices, the demand has already reflected in property prices, and you might be a bit too late to act then. All right, so what are the 4 that I'm looking at? Okay, first is the drop in total debt servicing ratio stress test. If you have been following the markets, I've been in this, I've been doing this job for more than 11 years, almost 12 years. TDSR actually started off as just 3.5%. It's only recently, I would say in the last 2 to 3 years, because of rates going up, that's why the stress test went up. Now it's as high as 4.8%. It's very stringent. Although fixed rates, has already came down to as low as 2.7, but you are still being assessed at 4.8. So this is just a very simple analogy. Let's say as an assessable income, you have a combined income or your single income is 12,000. You are looking to buy a property, and let's say your tenure is around 25 years. You go to the bank, you ask them for in principle approval, you will be assessed as only able to get a loan of 1.15 million. But if this stress test comes down with the dropping of the interest rates, and it comes back to the normal stress test that TDSR first started with, right, then your affordability suddenly goes up to 1.3 million, which is 160,000 to be exact in different. And 160,000, if you look at it, it's quite a big amount of money. Just based on the loan itself, it's more than 10%. And for a down payment of, let's say, 25%, it forms probably 50% of your down payment. So freeing up another 160,000 of cash would, if you ask me, create a lot of demand to the market because more buyers are able to buy a certain quantum of properties now then. Okay, and again, this is assessed based on the 12,000 income. And I mean, if you're buying private property, I would assume that you have been around the top 20 income earner in Singapore. Probably if you're using two incomes, you'll be at least 15,000 to 20,000. The difference in loan affordability will be even bigger. All right, so this is the first point. And of course, the second point will be the drop in monthly installment. I think this one, it's quite understandable easily. But if you put into numbers, you can understand the magnitude of it. Just before I forget, maybe I just tune back to my previous slide down here. Just a heads up, the stress test for UOB has already been revised lower. It's not fixed at 4.8. You know, it comes down to as low as 4.2% already. So we are actually on the way. How they derive 4.2 is 0.6 plus the 3 months SORA. I know most banks are still on 4.6 to 4.8, but lately I've done a deal and I know that UOB have already started with lowering their rates in the sense by reflecting it to the variable SORA rates. So it's already starting, okay? So the point number 2 will be the drop in monthly installments. I think if you look at the numbers, it's quite huge from 4%. I know some of you already refinanced to 3 point something. Some of you, if you refinance lately, it's only 2.7+%. It's great. But coming from 4%, let's say if you're in your final year and you refinance, maybe if the rate cuts are really aggressive and you get 2.5 in the next few months or so, that is a huge saving of $800. That's a monthly saving, $800 a year. It's easily, you know, almost $10,000. I think that's a lot of money. And that, of course, will make people, you know, more look at property as something more affordable. It might, I mean, for investment, if you're renting out to someone, then you know, you can actually even get back positive cash flow in that sense if you're using CPF to pay for a portion of that, right? So this is something huge with when the rate starts to come down. Point number 3 is something interesting. I've been in this line a lot long, that's why I can understand that it's not every time you see these things being done. Right now, I feel that during the high interest rate market, not many people are doing this. Obviously, because interest rate is high, the cost of capital is high. But when you see rates coming down, you'll see people doing more gearing up. Okay, so for people who don't understand what is gearing up, what is equity term loan, it means that if your property value is higher, it went up over the years, and you have paid down your certain loan, and let's say your loan, your current property value, the loan as a percentage of the current property value is only 50%, you can actually gear up by around 25% more because your maximum financing is 75%. So that equity term loan, that gearing up is that 25% that you can unlock. You can refinance and take out that amount of money to use it for your business, use it for other means, use it for other investments that can get you more than whatever interest rate that you're paying. Let's say if it comes down to 2.5%, you can put it up to a product, of course preferably something quite risk-free at 3.5 to 4%, you can yield the difference of 1.5 to 2%, right? So that equity term loan, I feel when it comes down to the 2% range, and if it even goes down to below 2%, I think this will be very popular in the market because property value went up quite substantially in the last 5 to 10 years. Okay, so when that happens, then of course you get more demand, right? For example, someone that owns, I've got many clients who own just one property using 2 names, or maybe their funds are a bit tight, or maybe they're deploying it to different areas now. But with the interest rate coming down, they can actually do the part sale decoupling and then gear up their existing property based on how much, of course, it depends on how much that the person remaining in that original property allows. Right, you must make sure that the personal income is high enough for them to do that gear up to get that total amount of loan. So you get that gear up, you decouple, you can actually buy another property comfortably without touching any of your own extra cash whatsoever. So this was quite popular back then when interest rate was low. Okay. Now the point 4, of course, I feel it's actually a combination of the last 3 points that I talked about. So probably just sum it up. You know, when your stress test is lower, your interest rates, your money installment is lower, you can do slightly more creative financing like equity term loan, then your investment appetite of course increases, right? So investment appetite, most of my deals, they're mainly for people upgrading, asset progression, elevating the asset from HDB to private in the last 2-3 years. But I feel when the rates start to come down, then this investment appetite for the second property to rent out, then maybe it will take place more often, and this will of course increase the demand for property and then increase in property prices. Yes, just a quick update on interest rates. Again, you really want to be forward looking and to front run this and to be proactive rather than reactive when everything has already settled, when the rates are finally down, and you really want to act. Maybe the price or maybe the unit available might not be there anymore. All right, so I hope this sharing, this quick little market update will help you. And if you need any personalized advice, do reach out to me. All right, and I'll see you for the next one.